Hey everyone, today is September 25th, 2025. We're going to go over a portfolio update, as well as I want to talk about two different stocks and use them as examples and talk about the relationship between the direction of a stock price and options. Okay, first of all, let's just go over an overview of the portfolio. So we're inching closer to 24,000, not quite, slightly down today. Makes sense because the market is overall a little bit down today. Past week, kind of flat. Past month, up 3.2%. Past 3 months, up 7.47%. That's really good. And for 2025, the year to date, that is the start of the year to today's date, we're almost at 8%. That's really good. Love to see it. Okay. So talking about what the relationship between volatility and stocks, I have two examples for you today. By the way, I found these just by chance because I was watching Bloomberg television. That's one of the sources where I get my news. I like it. It's neutral. They have, they bring on different CEOs on there to talk about things, financial markets. They have Republicans on there. They have Democrats on there. So I feel it's a good neutral source to get some news information on financial things and issues. And I like all the hosts I've seen so far too. So two of the things I've seen is about Wendys and about LAC. So first we'll talk about Wendys. They said Wendys was down, so I looked them up. Okay, currently we're at $9.16 today. For the past, let's say, year to date, you can see how it's been declining. Wow, huge drop. 43% down year to date. That's not good. I mean, that is not good. But I mean, I like Wendy's. They have good food. I love their fries. I think that McDonald's has better McNuggets compared to Wendy's. But yeah, that is not good for stockholders of Wendy's for this past year. And you can see in Robinhood, they have little recent news, little tidbits. You can see Wendy's is downgraded by Argus, with the restaurant chain seen as being in a rut. They are smaller compared to some other competitors. You can see Morningstar has a little blurb on them. The bulls say that as people think the stock's going to go up. They have perception of higher quality food. I agree. A little bit healthier relative health halo. I agree. They do offer salads. Other people don't do that. And the bears say, they're not as penetrated into international markets, declining traffic, and they're a smaller scale. So it's nice that Robinhood has all these different little tools where you can get a little insight into how a company is doing, what other people are buying and selling, little tidbits on news. And some of these things, if you don't see it, it might just be like for example, a research report that might be only available if you have Robinhood Gold. I'm not sure. So if you don't see something, it might be because you're on the free version and not the gold version. But really, I mean, for getting news, you could just look things up on the internet. I'm sure you'll find it. And you don't necessarily need gold to find all that thing, but it does make it more convenient. So anyway, when it relates to options, and not every stock has options, but this one does. You can click on the trade button. You can click on trade options. By the way, okay, so look at this chart. It's declining. Everyone knows it's declining. So if you click trade options, and you say, oh, let me build a strategy. I think it's going down. Okay, let's do a call credit spread. And 22 days from now, the expiration is October 17th. And let's say that you know that the share price, you can see right there, 916. You know that it's going down, and let's say you want it to keep going down, and so you say, okay, I want my lowest strike price to be $10 because I don't want it to go above $10. That seems pretty safe. So let's click on that. And our max profit is $10. Our max loss is $90. By the way, that's not a good ratio. You want that to be more like 1 to 3, ideally, maybe max 1 to 4 profit to loss ratio. So risking $10, but the worst is going to be $90. That's not a good ratio. And you click that little green up arrow, and you can hold your finger down on this to slide it. So if it goes down, the most you're going to make off of this is $10. As you go up, if the underlying stock goes up 9.11% or $10, as soon as it crosses that threshold, it starts to decline quickly, and at $10.10 you break even. And if it keeps going up, the most you'll lose is $90. So that's how that chart works. So limited profit at $10, also limited loss at $90. So really, how much you're willing to make in max profit, how much you're willing to lose in max loss, this deal just doesn't seem that good to me. So I'm going to back out of it. I mean, you could do it, if you have a firm belief that it's not going to, the stock isn't going to spike way up, and you can, and you're okay with that, then fine, you can get into it if you want. But the reason we're not seeing some good deals on that ratio is because the volatility is low. Volatility is low because everyone's thinking pretty certain that this stock's going to continue to decline. It's like a straight line for the past, since 2025 started. So, and by the way, volatility is how uncertain a stock is. So if it's bouncing up and down every day, volatility would be high, and options values would go up, and you could find some good deals on those. But since everyone's pretty certain the stock's declining, volatility is low, everyone's more certain, so you're not going to find as good deals on these kinds of stocks that have options. I also want to talk about width price. See this thing up here? Width is set to $1. So the width between the legs, $10 and $11, that's $1. Width between these, $11 and $12. So everything's at $1 width. Let's just see. Let's just pick a strike price. Let's say $10. Okay, now we can see different widths as an example. So up here we have share price $9.16. Strike price, we set the lowest leg to $10, saying I don't want it to go above $10. But as we have these spreads, we have $10 and $11, $10 and $12, $10 and $13. And over here we have the prices. The most you can make on this one is $10, $10, $5, $10, $8, $10, and then here's where it gets a little wonky. $10 and $17 for the spread, $10, $18 for the spread, and you get into negative numbers. These basically would never execute because no one would ever buy this, because you would go into a debit just to get into the deal. These are just funny numbers that appear because of the math. No one's going to get that trade through. But let's go to let's say $10, $16 spread. Max profit, $10. Max loss, $5.90. Whoa, what a goofy looking chart. That does not look like a good deal to get into. And let's go to a smaller width, say the $10 and $12. That one's better for you, but it's still not a good deal overall. So you can see the smaller the width price, the smaller the width between the legs is usually safer. It's usually less risky. And the wider the width is more risky. But it does have potential for bigger profits, but it is a lot riskier. So if you're a beginner options trader, I would definitely recommend setting your width to the smallest price. And you can test this out for yourself. Usually the wider the width, the worse deal it is, and eventually you get into something weird like these negative numbers that are just there because of the math behind it, and those deals would never go through. So that's how those widths work and volatility with the stocks. Another stock I want to look at is LAC, Lithium Americas. They had some news today that the government is looking to get into it. So the Department of Defense has already given them a grant worth millions of dollars. And the Department of Energy has a conditional loan worth over $2 billion with a B into Lithium Americas. And the Trump administration today has said that they're looking to renegotiate that loan. They want to renegotiate that loan to get them into an equity stake into this company, almost to the 10% mark, less than 10%. Because if you go over 10%, there's a whole different set of rules you got to follow set by the SEC. But it still would be a big equity stake. So then if Lithium Americas does really well, then the government does well. And so Lithium Americas, LAC, publicly traded company, I think they're based in Canada, but they are looking to operate in Nevada. And so you can see this past week, okay, our volume is in the hundreds of thousands, sometimes over 1 million. Then there's a jump in price. Whoa, tens of millions looking into it. Huge jump there. So past month, past 3 months, year to date, past year. Let's go back to today. So lots of volume activity. The price jumped. And you see Robinhood has this little kind of like a caution label at the top. This stock has recently experienced elevated volatility. Okay, what does that mean? So it looks back to the past, and if there's a huge price jump or fall, it'll put a little warning label on here telling you, hey, it's elevated volatility. And you can read through that. What's important is that if a stock's most recent daily return lies 6 standard deviations outside of its historical performance, higher or lower, then it has experienced elevated volatility, according to Robinhood's math they do. So 6 standard deviations is huge. In statistics, 1 standard deviation away from the middle of whatever you're looking at, so like a middle of the price. If it's 1 standard deviation away, it's like, okay, this is normal. 2 standard deviations, getting a little, still pretty normal. 3 standard deviations, oh, this is a big movement. 6 standard deviations is huge in statistics. So what we know about volatility is the more volatile something, the more chance of profit on options. You can see here they operate on the Thacker Pass project that is in northern Nevada. They, a very new company. They haven't sold a pound of lithium yet, but they are digging into clay lithium deposits. I think they're like the first commercially player in the world to do that. However, it is harder to extract lithium from clay compared to other established methods. They are still under construction, but they do have a lot of money behind them to get this done. Obviously, lithium is used in batteries for electric cars, as well as a lot of other things. A lot of batteries run on lithium. So if you click on trade options, you can start to build a strategy for this. And I did try to put in some options on this, and I'll just go back to home just to show you. Yeah, Lithium Americas. I tried to put in 5 credit spreads. It wasn't filled because I put them in at 15 cents. 20 cents was the high. 10 cents was the low. It probably would have been filled if I put it at 10 cents. I put them at 50 cents and no one bought. But that's okay. Let's see, what did I try to do? Limit price 15 cents, good for the day. 5 of them for a $5 put buy to open and a $5.50 put sell to open, but no one bought it. But it has elevated volatility, so there is a chance for you to make some monies on these options. So just to show you that. Okay, so if you like this video, please give it a like, consider subscribing, and I will see you next time.